Welcome to this explainer. Today, we're diving into a massive mystery that's unfolding right in front of our eyes this July 2026. Think about this for a second. Why on earth are companies reporting absolute record profits while Wall Street just violently punishes their stocks? I mean, it feels completely backward, right? Well, we're going to unpack exactly what's going on here, looking closely at the data to show you the hidden gears turning behind the scenes of the global market.
To understand just how deep this confusion goes, consider this number. The Nasdaq just suffered its worst two-week stretch since April 2025, dropping 2.1%. Now, a 2.1% drop might not sound catastrophic on its own, but context is literally everything here. This drop happened right smack in the middle of peak earnings season. That's a time when strong financial results usually send the market absolutely soaring. When you have record-setting corporate profits, the market should theoretically rally, but it isn't.
What we're seeing brilliantly illustrates our central paradox. We've got these diverging lines of strong corporate results crossing paths with an aggressive, downward stock sell-off. So what does this all mean? Well, we're not actually looking at a blind panic. Instead, as we'll see as we move forward, it's a massive, structural recalibration of capital efficiency. The market is fundamentally changing its mind about what it values, and more importantly, what it's willing to pay for.
Just look at the contrast here. In a normal market, these numbers would be celebrated. Intel completely blew past Wall Street estimates, yet they suffered a 7.9% drop in their stock price. And Alphabet? They boasted a staggering 82% growth in cloud revenue, only to see its stock slide 7.8%. Why? Because that growth was accompanied by sky-high, totally unprecedented spending. The governing insight here is that good news is suddenly bad news if the cost to achieve it is just too high. Capital efficiency is the new king.
So let's peel back the first layer of this onion, Layer 1, the AI CapEx reality check. We need to look closely at the technology sector where the market is suddenly demanding immediate returns on all these AI investments.
When we distill the Q2 scorecard, it's pretty clear. Investors are ruthlessly punishing vague guidance. Alphabet and Intel both beat top-line estimates but got heavily sold off because of their massive capital expenditure trajectories. But consider Tesla. They hit 480,000 vehicle sales, which is an impressive 25% increase. Yet the stock cratered 19% after a huge EPS miss. The market is weighing what we call a 175x hype deficit. Investors are absolutely exhausted by robotaxi hype when faced with real-world frictions. To give you a crazy micro-example of that friction, Waymo robotaxis have accrued over $9,000 in Austin parking fines. Yeah, it's real-world infrastructure clashing head-on with distant, lofty promises.
And the reason the market is so incredibly sensitive to this spending is the sheer scale of the ambition. The total compute pipeline is projected to exceed a staggering $500 billion. Let that sink in. We're looking at NVIDIA currently in talks to guarantee $250 billion in financing just for OpenAI. Meanwhile, Google Cloud is experiencing such a massive capacity crunch because they're growing so incredibly fast that they're actually having to rent third-party server capacity from SpaceX. The capital required to build this AI future is absolutely astronomical, and the market is, frankly, deeply worried about the return on that massive investment.
So the crucial point here is this value funnel. Capital is shifting. It's fleeing the top, meaning legacy applications and vertical software, dropping the IGV ETF by 16% as the market fears automated AI workflows are going to simply displace those older tools. It's also skipping completely past speculative hardware and humanoid robots. Instead, the capital is flowing strictly into the bottom, right into foundational security and infrastructure layers. This is exactly where the margin war is happening right now. And in this arena, Google Cloud is winning that war at an impressive 36%. Bottom line, if a company isn't providing the direct picks and shovels for this revolution, investors are pulling out.
All right, moving on to Layer 2, the macro game. Let's zoom out to the broader macroeconomic landscape because the rules of the entire global market have changed practically overnight.
We are transitioning into a completely different era of monetary policy, starting right at the top with the Federal Reserve. The pre-2026 Fed relied heavily on forward guidance, essentially holding the market's hand and telling us what they were going to do well before they did it. But now, under Chairman Warsh's new regime, we have absolute radio silence. They are utilizing Jacody's rules-based framework, which strictly ties interest rates to the Taylor rule formula. This means policy is purely driven by raw growth and inflation data in real time. No discretionary communication, no hand-holding press conferences. The safety net of predictability is totally gone.
Let's look at how this translates into an actual trading strategy.
Savvy investors are navigating this silent Fed using what's called the city hedge. It's a really precise three-step maneuver. First, a June rebalance stripped volatile growth stocks from the Russell 2000 index. Second, this caused an artificial drop in implied volatility, plummeting heavily from 90 all the way down to 56%. Third, investors exploit this anomaly to buy wildly mispriced iShares Russell 2000 ETF put options ahead of the Wednesday FOMC decision. They're essentially buying incredibly cheap insurance against a hawkish surprise from a Fed that now flat-out refuses to tip its hand. It's a brilliant way to protect capital when the central bank goes quiet.
Geopolitically, we're also seeing a massive trade recalibration. Since the Supreme Court struck down the temporary 10% global tariff back in July, the U.S. is implementing a highly complex, tiered system targeting under-enforced forced labor. This applies different tariffs, like 10% for Tier 1 or 12.5% for Tier 2 countries, creating very specific supply chain frictions across the globe. This new regime is expected to generate $2 trillion in revenue over the decade. For multinational corporations, this means suddenly having to reroute their entire manufacturing logic overnight just to avoid these targeted levies.
And in the energy sector, we've had a sudden geopolitical shift as well. A diplomatic truce, utilizing Pakistan as an intermediary, abruptly dropped oil prices 14%, bringing them safely below $90 a barrel. This matters immensely because lower energy costs ripple out into the broader economy, heavily easing inflation pressure. That, in turn, softens bets on a Federal Reserve rate hike. But on the flip side, it also sent major energy players like Chevron and ExxonMobil sliding downward as profit margins compressed. You see, everything is interconnected here. A diplomatic handshake in one part of the world immediately reprices corporate energy stocks in another.
Okay, let's move down to our final layer. Layer 3, the squeezed player.
We really have to look at the player operating under all this intense macro and micro pressure, the exhausted American consumer, and by extension, the retail investor. On the surface, they look incredibly strong. They're pushing a resilient back-to-school spend of $146.8 billion. To put that into perspective, that completely eclipses the spending of the Super Bowl, Easter, and Father's Day combined. It's massive. College spending alone is hitting $1,437 per student. That's the absolute highest we've seen since 2003. If you just look at the top-line numbers, it looks like a booming economy firing on all cylinders.
But beneath that massive spending number lies a deeply hidden exhaustion. Look at these bargain-hunting mechanics. Half of all consumers are now strictly buying only essentials. 20% are relying heavily on buy now, pay later credit systems to stretch out their payments. And perhaps most tellingly, 17% of consumers are literally working overtime specifically just to fund these everyday purchases. The American wallet isn't strong, it's stretched to its absolute breaking point, artificially propped up by debt and extra shifts. Faced with these intense financial pressures, retail investors are essentially treating the market like a casino. They're playing roulette. In the first half of 2026 alone, the U.S. market saw 728 new ETF launches. People are desperately pouring money into ticketing gimmicks, chasing UFO themes or space funds, or they're parking their money in expensive, buffered boomer candy that promises peace of mind. They're also chasing yield illusions or utilizing complex tax skirting funds. It's a chaotic search for a jackpot in a highly volatile market where everyone is just trying to outrun inflation. Which brings us to our final section, the core truth, synthesis. Let's tie all of this together.
What this all means for your portfolio, and this is your definitive playbook for August 2026, is that the market is not experiencing a blind sell-off. It is executing a violent, deliberate recalibration of capital efficiency. Investors are permanently rejecting vague AI hype, legacy software, and a reliance on Fed-forward guidance. Instead, capital is flowing strictly toward foundational utility, like Google Cloud margins and heavy data backbones, and into cyclical hedging. The rules have completely changed, and the entire ecosystem is repricing accordingly.
As we head deeper into this August lull, the bar for earnings is permanently higher. So you have to ask yourself a tough question. Is your portfolio positioned for a blind sell-off, or are you prepared for a capital recalibration? Are you still holding on to yesterday's hype, or have you recalibrated to reality? Think about that. Thank you so much for joining me on this explainer, and I hope this helps you navigate the complex market ahead.